You can go ahead and get started. Welcome everyone to the September Accounts Receivable Core Committee meeting. Glad you all could join us. And Dan, thanks for coming over. My name is Gerald Floyd. I am the statewide Accounts Receivable Management Coordinator. Get these people in from the lobby here. Sorry. There we go. Glad you all could join us. First up, some sworn announcements. Just some reminders that today is the target date for submission of your year-end AR and LFO reporting. The target date is set in the honor roll criteria as a hope. I'll put it that way. It is not a if you don't get it in today, it doesn't mean that you are not going to get the honor roll. It is simply a mechanism by where, when we started looking at this and doing the reviews, it was if everybody waited until September 29th to submit, and there's 130 some agencies that I review, I would not be able to get through them in enough time that if there were any questions or corrections, that those would get made by the October 1 deadline in the statute for the LFO reporting. So we set September 16th, and it fluctuates to the same date roughly each year to give a couple weeks so that as a flood comes in, I've got some time to get through those reviews and be able to get back to the agencies, and if there are anything that does need to be corrected, you've got some time to do that before, like I said, that October 1 deadline. So it is just a way to, the sooner you get it in, the sooner I can review it, the sooner you can check it off your to-do list that you've completed that requirement. So even if you're not able to get it in today, as early as possible is still helpful. So let me know if you've got any questions or having any difficulties. I'm happy to help. As you prepare your data and something doesn't quite look right, you're not sure where to record something or a unique situation, I'm happy to help where I can. Any questions about the target date? Okay. Next reminder is since our next meeting won't be until November, this is a reminder that October 31st is the deadline for the FY26 Q1 ARPM report. So just wanted to make sure that was on your to-do list, that as you get through September and the annual reporting, we kind of jump right into the next quarter ARPM report. And we'll talk about that a little bit later, about some of the targets and so forth. But for now, just a reminder that October 31 is that Q1 deadline. Next on the agenda, let me scroll down here. End of legislative session bill review. Just wanted to kind of go through and give everyone kind of an update. There were several bills that died at the end of session, but there are a few that did get passed, mostly affecting individual agencies. The only one that I have as passing that was kind of an enterprise bill, as I call it, is House Bill 2463. And I don't think it really affects most of state government, but it increases the time for a defendant to respond to a small claims court filing from 14 days to 30 days. So it doesn't really change anything else, but extends the overall process a bit. I don't know how often state agencies go through small claims court to establish judgments on their debts, but if you do, you would be impacted by that just from a timing perspective. Then Then we have some agency-specific bills. Employment had a bill that basically expanded their authority to compromise certain debts related to, let's see, it's for grant repayments made to employers to authorize transactions that the director may waive, reduce, or compromise. So it just kind of expands some things that they already had for other areas into this additional program area. Judicial had House Bill 3825. It shortened the time frame for judgment remedies in criminal obligations without restitution. And this had to do with marijuana convictions. So basically, if certain conditions were met, then the judgment remedy for that marijuana possession is deemed expired. So a limited aspect of certain judgments, but something that may have a small impact overall for them. Mental health regulatory can now assess costs associated with disciplinary action against the person whom the action is being taken. Kind of has some tiered implementation based on if the cost is a certain amount. There's no cost passed. If it's between $3,000 and $6,000, it's 50%, so on and so forth. And it begins for actions in January of 2026. Agriculture, this bill makes some certain changes related to civil penalties for violations associated with disease control. Basically adds a new civil penalty for certain violations of ORS 596 and 600, and some new violations for ORS 633. But basically, again, items for Department of Agriculture only. And then there were a couple of bills related to civil penalties for the Racing Commission. Certain elements of violations are now identified as a civil penalty infraction and can be charged by the commission as such. And the last few that I've got here, State Fire Marshal Office can now seek recovery for cost of fire abatement and allows the recording of those costs as a lien. This one is a little bit unique in that in most cases it would be identified as a civil penalty, which civil penalty can be recorded with the county clerk to establish a lien. This does not designate them as a civil penalty, but those costs can be recorded as a lien. So a little bit different wording than I'm used to seeing, but still something that they can move forward with. PERS, let's see, this was increased the PERS board authority to waive amounts less than $200 in overpayments or improper payments. It was previously they could only do up to $50. So this is a little bit more of a housekeeping, I think, and probably keeping up with, I don't want to call it inflation, but, you know, kind of bringing it more current to today's standards, I think. And then finally, Board of Massage. If a location has been found to have committed a specific violation, then the Massage Therapist Board can place a placard on the exterior of that facility to notify the public of that infraction, and that if anyone removes said placard from that building, that it becomes a civil penalty for such violations, and up to $100 per day that that placard has been removed. So again, just kind of modifying slightly the specific authorities of that particular agency. So As far as bills that died in committee, I will send this out as part of the attachment, so I'll let you read through it. In terms of the bills that were introduced but didn't actually pass. There were some varieties in terms of agencies passing fees and prohibiting fees and so forth. One that I would suspect to see again would be this House Bill 3518, which would have increased the county recording fee. It kind of moved some money around, but it did ultimately overall increase the cost, but it kind of was how funds got distributed as well. But I would kind of expect that to probably come forward again, just because I'm sure the counties, as they continue to wrestle with financial, budgeting issues, this can certainly be something that they try and push for in the legislature, bring up again at their request. So again, a variety of agency bills. We'll let you read through those with the minutes. And then we had a number of bills that died at the first chamber deadline, second chamber deadline, et cetera. So look through each of those tabs as well if you are curious about those. So ultimately, there were a lot of bills initially, as you've probably seen in the news. It was almost a record year for bills introduced. We had, I want to say, between 25 to 30 that we kind of monitored throughout. And again, what came through ultimately were a bit more of a housekeeping type thing as it relates to primarily civil penalties and some things like that, but nothing major, no big policy shifts that came out of this session. So that's a good thing. Any questions about the legislative session and or any bills that I mentioned? Hearing none. Okay. Next on our agenda is the PCF contract renewal update. For those that aren't aware, because you're part of centralization and you don't have to do this yourself directly anymore. The current statewide price agreements are due to expire in April of next year. So this spring and summer, I worked with the state procurement office and a group of folks that were kind of representatives to help us review the existing price agreement for language and what things we wanted to see going forward, and issued an RFP and had evaluations. There were like 23 proposals submitted. We did independent scoring, and pricing was a separate component tracked through the state procurement office. There was a formula based on what they bid versus others and kind of what percentage of those available points they got. But in the end, the natural break in the scoring came at 11 contractors. So the state procurement office currently in the process of finalizing those agreements. There's what they call a negotiation phase, although there's very little to really negotiate in this particular price agreement, but that's part of the standard process for procurement. So those will then be available. And why we started the process as early as we did is we wanted to ensure that if there were any of the current vendors that might not have gotten selected as or awarded a contract going forward, that we had plenty of time for agencies to transition. In other words, begin to issue what I call purchase orders. I know that term has changed slightly, but issue a new purchase order with the new vendor that they want to select from. The contract does require agencies to do what's called a best value analysis, and that is going to be available on the OregonBuy site for agencies to use. It's essentially, you're kind of evaluating all elements of what does the contractor offer, what is your needs, what is their pricing, and ultimately, what is the best value for you as the agency for you to determine which one of those 11 you want to, well, one or more. You don't have to just select one that you want to choose. And it's basically just an internal procurement process that would be done. And then you can begin to migrate those accounts as the other vendor would be sending them back through completion of the life cycle, and have sufficient time that you're not, in some cases, dealing with large quantities of accounts and asking for them to be returned and reassigned and adding a lot of extra work that you can't now be done over several months instead of if we'd waited longer, you would have a much shorter window to do that. So in our November meeting, I will hopefully have confirmation that all of the price agreements have been finalized and contracts signed. I will hopefully be able to share a list of additional services. So the RFP was related to debt collection, but in their pricing, they could give or list additional services that are related, but maybe not fall under the direct scope of debt collection, and what pricing they charge for those services. I will try and be putting together a summary of what are those additional services that will now be available for agencies. And an example of that might be outsourcing your letter writing. So you have a spreadsheet of here's all my new accounts that are delinquent. I need to send a collection letter. You give them the format of what that letter needs to look like. Send them the file of the entities you want that letter sent to, and they kind of do the merge and get it in the mail and do all that stuff for you. That's an example of an associated type service that could be included in those pricing proposals. So you may not be directly using a PCF for debt collection if you're, for example, an agency under centralization and that's being done by DOR. You may find some value in using those other services if it's something that you want to do. You would have the opportunity to use those services under those price agreements. So just a bit of an update on that. And so, again, price agreements are available to especially any agency that is not subject to centralization. You have your own procurement authority, but you may choose to buy under a statewide price agreement. You can evaluate these contractors and potentially look to make a change, or if your contract is expiring, you may choose to use one of these instead of doing your own RFP. So just again, an update on where we're at with that. I know a large majority of agencies are going to be primarily unaffected. You could see for centralization agencies, you may see at DOR the status reports if they have to pull an account back. You may see it come back and go back out to another PCF under the new price agreement. Just be aware that you may see a little bit more activity in that regard as they go through this process and doing the best value analysis and determining which vendors they want to use under the new price agreement as well. So any questions on the PCF contract? Everybody's unmute button work? Just checking. Moving on in the agenda then. ARPM targets. Reviewing your actual data and evaluating your expected activity to establish next quarter and next fiscal year targets. I wanted to share, this is just a completely made up template that I did for example purposes only. This is nobody's actual data. This is truly just my, putting this together for the sake of this conversation. One of the things, here you'll see, under the collections, how the targets each quarter changed slightly based on what that target became in terms of an actual. So for example, quarter one, or I should say the quarter two target of 7.5% calculated to 1,575. The actual collected was $2,000, so the target was a little bit low. Now you'll see, you would think, oh, well, that target should go up. Well, targets also have to account for what do you expect to happen in the next quarter. So in this example, it went from 7.5 down to 6 in the next quarter, because there's an expectation that we weren't going to collect the same $2,000. Actually, I'm on the wrong column. So it was 5%, and then, no, my target was 7.5. It calculated to 1,575. So we collected more. You would think that the target would go up. However, the expectation is that we actually would see a decrease in quarter three. So the target did go down. It's not just what was your actual and make it be that. It is more. You have to put a little bit of, I call it the crystal ball. And what do you think will happen in that next quarter? In this case, we thought collections would go down. As it turns out, in quarter three, in this example, it actually did. And so you can see how those change both for the total collections and the L&D. Most agencies, I will say, do a fairly good job of this type of analysis. Some take whatever it was at the beginning of the year and they use the same targets every quarter going forward, regardless of what is actually happening. That's not what this was truly intended to be, especially at a quarterly level. What do you think will happen in the next quarter, and establish your target based on that. And in this case, some quarters were higher and others were less. It's perfectly fine if you don't exactly hit your target. But the idea is that you're setting a target based on certain assumptions. Those assumptions will not always come true. Other things will happen. You'll have anomaly large accounts that will fluctuate your data. Establish the target on what your assumptions are will happen, and as long as you are making some of these ongoing corrections, that's all we ask for. We don't, you're not going to get penalized or chastised for not having an accurate forecast of what the target should be, but we do want it to be updated on a regular basis. Same thing here with the accounts outstanding more than 90 days. Here you can see where throughout the year it kind of became where most of the accounts were more than 90 days past due. And as you get throughout the year, those were adjusted accordingly. Same thing when you're looking at your annual measures. Here was the actual, here was the current year target, and here we're changing that for the next fiscal year based, in this case, it comes pretty close to what the actual was. If that's what you think will happen in the next year, adjust those targets accordingly. So just a reminder to continue to evaluate those each quarter, and when you do the annual, set those targets for the next year as well. Any questions on setting the targets before I go into kind of moving from one fiscal year to the next? Okay, hearing none. So on the quarterlies, it's pretty easy. There's a field for each of the, targets. What I would say, as you complete your fiscal year 25 report, what you will want to do is prepare, and by prepare, I'm saying, get your template ready for your FY26 reporting. So you'll start by coming to the summary tab, changing the fiscal year. Looks like I'll have to post a new version for this by next year since it'll be out. So this will be the next quarter. Now, what you'll end up wanting to do is taking this next quarter one and move this over to become your quarter one target. So it was 7.5 and 95%. Why is that? There we go. 95%. There. Now you can go through and delete the targets that were from FY25. And the same thing with your actual data. Again, you're preparing this template for the next report. So you'll do the same thing here. You'll take your quarter one target and you'll move that over here to your quarter one, zero out the actual targets during the year. And obviously you'll delete the actual data as well. Now for the annual measures, these are formatted slightly different. So what you'll do is you'll copy this next fiscal year. Again, this is what you did for your FY25, and you'll move that up. And your current year target is now listed for FY26. Since we're not actually doing the end of FY26 report right now, go ahead and delete that until you're doing quarter four of FY26 and you're preparing the annual measures at that time. Same thing for these other tabs, but by doing that, you've now put everything in as for the FY26 reporting cycles, the correct targets for that first quarter and or the current fiscal year. I have, and I say this because I do see folks who in their FY25 reports, the current year target that was included was not the same as what the next fiscal year target was when they did their quarter four FY24 report. I don't know why it changed, but if you set that target and you submit it, don't change it after you've submitted it. You can change the target for the next year when you're doing, or the next quarter when you're doing that element, but don't change a target after the fact. It shouldn't be, oh, the actual turned out to be 35%, so I should go and change my current year target to 35. That's not what we're wanting to do here. So just a reminder of kind of how to go through the process of setting this up so that you are prepared for your data entry in FY26. Any questions on that? speaker on this thing? Okay. Next on the agenda, OAM 353080 offers in compromise. I'm on the right one here. Yep. So here's OAM 353080. Now, I bring this up today not because there's been any change to this, but more, we've had some conversations about write-offs and so forth, and offers in compromise are probably a little less utilized by agencies. It is something that you can do. Some things to be aware of when you're looking at this policy. First of all, an offer in compromise is essentially a partial payment to fully satisfy a debt. An offer in compromise can come from either the debtor or the agency. Some people think it's just the debtor asking you to settle an account, which is another term for offer in compromise. But it actually can be something that, if I'll use the analogy of the sob story. You have somebody on the phone and they're telling you their life story and why things are so difficult and why they can't pay it. An agency can offer to settle a debt or an offer in compromise in certain cases as identified in the OAM. However, the agency needs to have taken reasonable effort to collect the debt. Often that includes assignment to DOR if you're an agency subject to OS 293. But it ultimately boils down to, does the account qualify under the criteria that is either listed in the OAM or has been approved by the Department of Justice, because the OAM does state that agencies, one, must adopt criteria. And you can adopt the criteria in the OAM because that has been approved by DOJ, or if you have something different, you can submit that to DOJ for review and get an agency-specific criteria. This is very similar to the write-off process in the OAM. There's criteria for write-off that the AG is approved, and there is a process for an agency-specific criteria. This is very similar to that. But the important part is the agency needs to have adopted essentially a policy. When is it appropriate and what criteria is used for offering or accepting an offer in compromise? Note that some of the criteria that is in OAM 353080 is the same criteria as write-off in 355010. For example, the debtor does not and will not for the foreseeable future have rights to assets which could be used to collect the debt. That is the same criteria as OAM 355010 criteria 1. The estimated cost of collecting the debt would be equal to or exceed the amount of the debt. That's the same as criteria 2 in the write-off policy. The debtor is deceased and there are insufficient assets in the debtor's estate from which to collect the debt. Criteria 3 from the write-off. So on and so forth. They're not all exactly the same, but there are some of those elements that are the same. So bottom line, really what this boils down to is whether or not there is any form of communication with the debtor that will give you an indication that they could have some means to pay part of the debt versus they're just simply not responding to you at all. And why is that important? Because if they're not responding at all, you can't understand their financial situation to know, could they pay a portion of it? So you're likely reviewing it and saying, the cost of pursuing this would be equal to the amount of the debt. I'm going to write it off. But if you have them on the phone and they're giving you their, what I call the sob story, you could find out, well, maybe they could pay 25% of the debt, and that's better than nothing. So go through and offer the potential for a compromise if it's within your agency policy and the criteria that you've established. Accepting a compromise is not a bad thing from a public PR perspective. It is something that you can explain that given the situation, you felt that this was the most that the state would be able to collect. Versus if you used the hard line and said, nope, you owe the full amount no matter what, they may say, fine, I don't have the money to pay it. And unless you go through the legal avenues to enforce it, by obtaining a judgment, for example, and seizing assets, you're not going to get them to pay. But if you get them to accept an offer and compromise, you've gotten something out of them without having to go through that additional expense. So that's really the what I see as the difference between the two, is whether or not there's an active communication with the debtor. Again, agencies must adopt the criteria, so you need to have that internal policy. The OAM on compromise, it is important to note that this does not apply to debts for which a procedure for compromise, release, discharge, waiver, or cancellation, or other forms of settlement for reasons other than uncollectability can be used by the agency. Some agencies have, by statute, authority to compromise. For example, on a civil penalty, you've issued a penalty. The agency can typically reduce that penalty in certain circumstances. That is not this policy that you would fall under. That is the agency's authority to issue the penalty. You can change that penalty under a separate statute. So, one additional note is that an offer in compromise may not be made or accepted on a criminal money judgment that includes restitution or a compensatory fine. So those are called out in the OAM and are based on ORS 293240, but you do need to understand what criteria you're using. This is related to uncollectability. You've made that reasonable effort to collect, and one of these criteria applies. Your policy says we can accept or offer a compromise. And the other element of this is this is a case-by-case basis. It doesn't mean you automatically start off at pay 25%. One of the items in here, the debtor may submit a financial statement. Given their liabilities and their assets and potential future income, you're determining what could they pay. It may be 50%, it may be 60%, it may be 20%. It's going to be different with each individual case. So your policy, I'm going to say, should not say, we will accept 25% on all accounts, irregardless of anything. We just want to collect 25%. That's not what you should be doing. It is a procedure for what criteria, like those that are listed in the OAM, might apply, at which point you can begin the conversation of what could you pay? Can you give us this information to confirm that that's all you can pay? Then move forward with whatever your internal procedure is for the approval, whether that be a manager, CFO, et cetera, that can then sign off on that. Once you've gotten to the step that you've offered and it has been accepted, or vice versa, the agency must document the criteria by which the debt qualified for the compromise. And there is a form, OAM 753514.FO, that can be used. It basically looks very similar to the list here. You put a check mark next to the criteria that applies, and you're documenting which criteria applied. This is to be kept with the account or documented in your agency system. This is for future reference. Why did we accept a compromise? And or for an audit. Why, if that audit says it was $1,000 debt, you only collected $250, what happened to the rest? Here's our supporting documentation. You also would then provide the debtor with, you're required to provide them with a written agreement. You want them to sign saying, I accept, or I offered and you accepted, and I'm acknowledging with my signature that if I pay 40% of this debt, the balance will go away. And that's important because now they're acknowledging that they are willing to pay that amount. But you have to do that. There can be a sort of a cover letter that summarizes the terms. The OAM also describes that both of those should include language about what happens if they don't abide by the terms of the agreement. Part of that negotiation of the compromise can also dovetail into a payment plan. They'll pay 40%. That means you owe X amount. Will allow you to make payments of X amount for 6 months, 12 months, whatever that is. It's going to depend on the balance to be paid and what their abilities are. You're kind of combining the process of a payment plan with the settlement to get them to actually begin to resolve the debt. But you can combine those two things. Once the debtor has met the terms of the agreement, whether that's a single payment or the final payment of a payment plan, at that point, the agency can adjust the balance of that account to zero. And I use that term very deliberately because until they have met all of those terms, the balance of that debt can still be reinstated. If they don't pay by the date they agreed to, the offer goes away. It's a null and void agreement. It should also include the language about potential going to Department of Revenue, additional collection fees, all of those types of things. The same type of information that goes into your original collection letters can be and should be included in the offer and compromise agreement form. It's part of the terms of the agreement. You're letting them know and reminding them of what actions will be taken if they don't abide by the agreement. So that kind of gets you through that process. It is important to remember to track the accounts in compromise because for LFO purposes, you do have Section 3C, which includes the entire lifetime of that account. So if that payment plan is for 24 months, at the end of 24 months, you're going to report in Section 3C what was the original debt, what was any fees, interest, etc., that was added to the debt, what ultimately did the debtor agree to pay, and what did you as the agency then settle for. And that's excuse me, only reported at the point that they have completed their requirements under the agreement. So they have paid off their portion that they agreed to pay. Then you include it in the LFO for that fiscal year. So that kind of gets you an A to Z on offers and compromise. Just remember to go through and look at 353080. Make sure you have an internal agency policy, and then you can begin to include that in excuse me, your agency process. Again, this is only limited to generally those cases where you're having active communications with a debtor. It's also important because if you send the account to DOR and they try to negotiate with DOR is going to go to you, the agency, and say, what's your policy? Will you accept this? If you don't have a policy, you don't have anything to respond with, you can miss out on an opportunity to have this occur through DOR, but they can't approve it on their own. They need you, the agency, to approve whatever's being offered. So get a policy in place. To what degree you use that is, I'm sure, going to vary by agency, but it can be a useful tool in select cases. So any questions on offers and compromise? Hearing none. Anybody have anything for roundtable that they would like to bring up?
We're a new agency and we have a DOR account that we just were informed has filed for bankruptcy. Any advice on what we should do? I actually realize we're going to need to write it off as well, but as far as the DOR process, notifying them, and I don't know if the notification came from DOR. I don't think it did. I got it from an employee.
Okay. So for one, I would certainly communicate with DOR that your agency has been made aware to, if you were mailed paperwork from the trustee of the bankruptcy court, that would certainly be helpful to get them a copy of that so that they can update their system so that they don't accidentally violate the stay. They can argue that they weren't aware so that they wouldn't be penalized by the court, but as soon as you want to make sure that DOR knows. Sometimes it goes the other way, and DOR will be notified electronically through systems, and it will flag an account and then kind of comes to you as a status. But if it came to you first, certainly make sure that they're aware. The important element is it doesn't automatically mean you just write off the account. A bankruptcy, there are a multitude of things that can impact what your next steps are, including what chapter did they file. Was it for example, a chapter 11 where there's a repayment plan? And is your debt going to be included in that? Some debts are and some debts aren't included in a repayment plan. It depends on whether or not it's considered a secured debt. So it kind of depends on what caused the debt for your agency. If it was, for example, a civil penalty that was recorded with the county clerk, you've got a lien in place, it's considered a secured debt. They would need to include that in the process of the repayment in most cases. And I say most cases because there's one thing about bankruptcy I've learned is nothing is 100% all the time. But at minimum, you want to wait to see what is the next steps of the court. Because just because they file does not mean that they will meet all of the requirements of the court, and a case can be dismissed, which means you go right back to collecting. So if you wrote it off and then it becomes dismissed, it's gone. You don't even think about it anymore. You would want to wait to receive the notification of a discharge. That means your debt was by the court deemed no longer owed. Then it is an adjustment on your debts, very similar to the adjustment for a compromised account. In this case, the court's telling you no longer can legally pursue that debt if it's included in the bankruptcy. So it does depend on what chapter they filed. Did they complete all the requirements? Is your debt included, not included? They may have filed, but if your debt, for example, if they filed on June 15th and your debt came from an activity that occurred after that filing date, your debt is not included in the bankruptcy. It's only debts that were incurred as of the time that they file. So you got to look at a lot of elements, but certainly the number one thing, make sure DOR knows that there was a filing if it's an account at DOR so that they can make sure that they don't accidentally do something that they're not supposed to. Courts sometimes, are state agencies separate entities under the law, or are we all one umbrella, government? So it kind of depends on how they look at it. So
It
I'm
looks
sure
like
that,
it's chapter 7, and it was for some COVID grant funds that they needed to repay.
gotcha. Yes, I mean, there are certain things that even in a chapter 7, some things cannot be discharged. So it just depends on the nature of that debt. I would suspect that grant funds probably are dischargeable.
Okay.
But, you know, if there's,
Dischargeable meaning still like
meaning that
collectible within the bankruptcy?
yeah, meaning that the court can say they no longer exist.
Oh, they
Um,
can. Okay.
yeah, some debts, the courts may be able to say you cannot include certain debts. So, for example, I believe child support is one that you cannot get discharged in bankruptcy.
Okay.
So, it's the nature of the debt as to whether the authority of the court applies or not is one way to say that.
Okay. Great. Thank you.
And certainly, if you have individual questions about a case like that, it's always best to talk to your agency's AG to say, what should we do with this? Is there, is this something that can be discharged in court or not? And they can answer those kind of questions for you. But general rule of thumb, you want to, it's not something that you automatically just say, oh, write it off. They filed bankruptcy. There's more to it.
Okay. When you say AG, I'm assuming that means our attorney.
Yeah, DOJ.
Okay, great.
Any other questions?
Of course, our boss is on maternity leave for 3 months, so I kind of have to do this myself. So do we have it's a general counsel for all state agencies? Is that what the Attorney General is?
Um, Usually there is certain AGs assigned to different agencies, if I
Okay.
remember correctly. Um, you know, do you know who to, um, yeah, you might check with like your director's office. I'm sure would know who
Okay,
your agency's AG is, and
great.
yeah, let them know, hey, we may need to ask this question because, of course, there's going to be DOJ charges for
A
any
cost.
questions that
Okay.
they answer. But I would let them know, hey, we've got this situation. We need to kind of understand what our next steps should be based on from a legal perspective. So, and again, this all also looking at what is the balance owed. If it's hey, they owe $800, probably going to DOJ, I'm going to say you're going to spend that much in AG charges to get your question answered is versus, well, let's just see what the bankruptcy court sends us next.
Okay, yeah, they actually owe 57,000, so I think it would be worth it.
There you go.
Thank
Good
you.
example. Any other roundtable questions? Okay, hearing none. Our next meeting will be on November 18th. So, again, thank you all for attending today and look forward to, I was remiss earlier when we talked about the target date for submitting. For those that have already submitted, thank you, thank you, thank you so much for getting those in early. I really appreciate it. We actually are about 1/3 of all agencies required to report have done so already, so that's a big burden off of me to have to look at those for the rest of the month. So I want to really thank all of the agencies that have met that target date so far. If you have any questions as you're working on your reports, reach out to me, send me an email, send me a Teams question if you're on Teams. I'm happy to answer those as best I can to get your data as accurate as possible. So with that, we will be adjourned until November 18th. Thank you, everyone.
Thank you.
Thank you.
Thanks.